Hey, where the money at? Tell me, Big Vel, where the money at? Guys, welcome back to another video, okay? Welcome back to another video. You're here at Learn with Vel, and today I'm going to tell you guys where the money's at. Now, it's very important to make sure we understand that when we're trading, we understand multiple concepts, or we understand multiple basic concepts. If you guys have watched ICT's videos, he takes 3 hours just to say something that could be said in 10 minutes. So I'm going to give you this in a short space of time, and what this is going to do for you guys online is it's going to have you understand exactly what liquidity is, how you can understand it, how you can highlight it, and how you can use liquidity to your advantage. So if you're watching this right now, make sure you like, subscribe, you know the vibes, it's lit side. So let's get into this. Now, first thing here, as we can see, we have got what we call an equal low. Now, equal lows are very simply what retail traders would call support, okay? But we call them equal lows. And to get an equal low, very simply, is when you just have 2 points in the market that are at the same level. Now, nothing in life is perfect, of course, so we're not looking for a symmetrical level. It doesn't have to be symmetrically in the same line. It just has to be close enough for us to see at a glance. If we step back and we have a look, that hey, that point and that point are fairly close to each other. So actually, with these 2 points being fairly close, that's going to be an equal low. Okay, and what this is going to represent is actually the fact that, well, Forex traders in general who are retail traders, they're always told to put their stop loss beneath the previous low. So when they have their stop loss beneath the previous low, which is, for example, if they're buying here, they're placing their stop loss beneath this low, that means inside of this area is a pool of money, okay, inside this area here. Now, with this area being a pool of money, money in trading terms is liquidity. Now, liquidity in layman's terms is your stop loss. When you get stopped out of a trade, do you get your money back? I'm pretty sure if you've taken a trade, you'll know you don't. Okay, if a trade hits your stop loss, you're out of there. He's gone. He's out of there, Frank. Okay, and that means, of course, if your trade has its stop loss hit, so if your stop loss gets triggered and you're out of the trade, now your money's gone to the market. Now, the market understand this, okay? They understand the psychological aspect that when a Forex trader with little to no experience, or even with experience, okay? But when a trader can do something that they want him to do, they're able to manipulate you. Now, the manipulation is very important because there's only one person you will ever listen to throughout your whole life, and that's yourself. And I'll give you an example why. If we go to a casino and I tell you, hey, put your money on red and it lands on black, you're not going to listen to me again. If you've got common sense, you won't. So, but who you would listen to is yourself. If you told yourself that there's only one person that you're going to live with for the rest of your life, and that's you. So the market understands that people naturally don't like to be told what to do. It's scientifically proven. People are more inclined to say no when people ask them to do stuff. So because the market understands this psychology, what they actually do is they put you in control. They make you feel that you're deciding where you want your stop loss to go, so that when your stop loss gets hit, you're not looking at it thinking, damn, why did I follow his instruction? I'm not going to do it again. Instead, you're thinking, they caught me this time, but next time I'll do better. So with that being said, how the equal lows are formed is because what these are doing from a retail perspective is these are creating a safe haven. Okay, they're creating what retail traders call support and resistance. We'll get into the resistance part a bit later on, but right now the support, which is this level down here, is what they're creating. And for retail traders believe that support is safe. They believe price is impenetrable. They believe if a tennis ball is to come down here, it bounces off. If it comes down again, it bounces up. If it comes down again, it bounces up. This is what retail traders believe. Price will always bounce off of a level. Okay? Now, the reason why, what I like to say is this is a, where's the text box here? This is what you call a false sense of security. Okay? An equal low is a false sense of security because what retail traders believe is when price comes down to this level again, price will bounce up. Now, in some cases, you might be right. You might get beginner's luck. Price might bounce off of this level 1, 2, 3, heck, maybe even 4 or 5 times. But what price is doing is it's growing, and it's growing the equal low, but it's also attracting more attention. Meaning, the wider the equal low, the more obvious they're trying to make the picture. For example, you've got 1 point here, you've got 1 point here, which makes the equal low. But in some cases, you've got an equal low here, and you've got an equal low here. If we had an equal low from, let's say, this point here to this point here, for example, the wider the equal low, the more obvious they're trying to make it. Meaning, the more attention they're trying to draw into this picture. And the attention they're trying to draw in is basically saying, hey guys, place your stop losses beneath this low. Price will not go beneath this level, place your money inside this zone. And when price does go beneath these zones, and when there is enough stop losses inside of those zones, what price will do is simply reach in, stop you out of the trade, and then go in the direction that you wanted it to go anyway. Now, comment below if this has happened to you before, you've been stopped out of a trade and then price has gone in your direction. Well, now you know why. And one of the biggest or worst kept secrets is that the market makers, they know exactly where every trade is being placed. What do I mean by that? I mean, if we have a look over here and we can see we have 1, 2, let's go into drawing mode. 1, 2, 3, 4. 1, 2, 3 to the 4. Snoop Doggy Dogg and Warren G at your door. So let's just say we've got 7 levels here, 8 levels, I'm not sure, I'm just guessing. Now let's say we've got 30 mil here, we've got 10 mil here, we've got 80 mil here, we've got 15 mil here, we've got 35 mil here, we've got 6 mil, we've got 2 mil here. Here's where we have 80 mil, okay? The market can see on the right hand side, the market can see where everyone's orders are, they can see where everyone's stop losses are. What I'm saying to you is if there is 80 million on this number here, 1.86198, if there is 80 million pounds or dollars or euros, whatever you want to call it, if there's 80 million, okay, let's say $80 million, if there's $80 million on that number, and it's people's stop losses, I'm telling you, the market is going to come down to that number and it will wick that number and go back up. So what we have to understand is the market isn't telling you directly what to do, but indirectly it's leaving a subconscious thought in your mind for you to place your stop loss in areas that they want you to. Because what they're basically saying is, hey, look, we want to take your money, but how can we do that without you guys feeling like we're taking your money? How can we do that without you guys feeling like you've got no chance in winning? The only way to do that is to create these traps, and then what happens is the internet gets flooded with all of this retail information. And if, in my personal opinion, all of this retail trading method stuff is how you get caught in the bear trap. And that's what these are. These are essentially bear traps. These equal lows and equal highs. An equal high would be, for example, you've got 2 points like so, here and here, that's an equal high. When you've got 2 points in the market that are equally the same height, it's an equal high. Like in here, for example, equal high, okay? In here, equal high, here, equal high, okay? Inside here, equal high, right? These equal highs and equal lows form liquidity, okay? Because it allows people to have confidence to think that these areas are impenetrable. Price will never go above them. So the key word so far, guys, is full sense of security. That's what a support or resistance in your terminology is going to be for me. A full sense of security. So as we move on now, I've marked out a few of the equal lows. Okay, we have one equal low here, the second one's here, the third one's here, the fourth one's here, the fifth one's here, and the sixth one's here. Okay, we have 6 equal lows, right? Now, I'm going to show you guys the equal highs. If I move this up and come up here, I'm going to show you equal high. So here is an equal high. I'm going to change this color to blue, Nipsey blue. Okay, we've got one equal high here. Second equal high is right here. We're going to go, the third equal high is here. The fourth equal high is right here. And then the fifth equal high is down here. Okay? So we've got 5 equal highs, we've got one more inside of here. So let's take this one here. Got one more equal high over here. Now, each equal high that I've drawn out, you've even got one in here. Each equal high that I've drawn out, okay, I want you to have a look at this picture. Now, with the equal lows that I've drawn, we've seen that price has been This is a bullish structure because price is making higher highs and higher lows, higher highs, higher lows, higher highs and higher lows. But if we're thinking about higher highs and higher lows for a second, okay, there's a unique difference between an equal low and an equal high in a bullish structure. And that difference is that when price is bullish, all of the highs are taken out. When price is bearish, all of the lows are taken out. For example, because price is pushing up, okay, it's pushing past each equal high, right? Eventually, at some point, all the equal highs, price is going above them. So I'll break it down to you even further. Because price ends up over here, right over here, we know that every equal high that we've drawn out is invalid, meaning that price has already gone above there. So if price has already gone above that area, then that means if you had your stop loss inside of this area, you already would have been stopped out. There's no way you could still be in that trade. Price has surpassed this level, right? So all of the equal highs are no longer valid. I think we can agree on that here, right? All of the equal lows, all of the equal highs are no longer valid, okay? Now, with that being said, I want you to answer me this question, and I want you to pause the video so you can think of the answer. If there is more equal lows valid than equal highs, would the market have more of a reason to push down or go up? Pause the video. Okay, so the answer you guys should have guessed, or you guys should have worked out, is down. Now, I'm going to ask you to pause the video again, right? The markets would come down because there's more equal lows and highs. But my question to you is, why is that? Can you guys tell me why that is? Why would the market be more likely to be coming down because there's more equal lows than equal highs? Pause the video again. Let's take a second and answer the question, okay? The reason why the market would be coming down is because there is more liquidity, and I hope you guys guessed this word correct. There's more liquidity below than there is above, right? Beneath an equal low is liquidity. Beneath an equal low is a full sense of security, which means it's people's stop losses, aka it's money. So there's more liquidity below than there is above. Why? Because all the equal highs are invalid, meaning they've been taken out. So if they're no longer valid, then there's no money above. The market is always going to go where the money is. And that is why today's lesson is called Where the Money At. Okay, where the money at? Hold that jagged edge. Hey, where the money at? Girls are in the money and the money at. It's a big song, okay? But they actually say where's the party at? But I digress. The point and why I'm showing you guys this is because it's important to understand that just by understanding where the money is, we can now understand the direction of the market. Okay, so I'm going to write this down for you guys. If there is more equal lows than equal highs, price will go up. If there is more equal highs than equal lows, price will go. If there is more equal highs than equal lows. Okay, if there is more equal lows than equal highs, price will go down. Sorry guys. And then if there's more equal highs and equal lows, price will go up. Now, I'm not saying that this is going to happen imminently, because quite frankly, there's no time period to when this is going to happen. But what I am saying to you guys is that this is a reality, okay? Now, because we've understood right here that there's more equal lows than equal highs, we understand that price should come down. That doesn't mean price needs to come down today. Price could continue making higher highs. It could do that, higher highs, higher lows. We can see that it's still pushing higher, right? But each time price is pushing higher, it's just taking out the previous equal high. And in most instances, we can see apart from this one here, which is not valid, the rest of the equal lows are valid because price did not come back down beneath that equal low. In this case, we can see price came beneath the equal low. So we remove this equal low and we stick with the rest. Okay, we've also got another equal low inside of here. Now, by the time we get up here, we see prices pretty much reached its peak and now it's starting to turn around and potentially push down lower, right? But what we've understood is that now, if we count up the equal highs that are valid against equal lows, we will be able to understand the direction of the money. The direction of the market equals the direction of the money, right? And we can see we've got 1, 2, 3 to the 4, Snoop Doggy Dogg and Warren G at your dope. So we've got 5 equal lows, but as I said, guys, we could draw another one here. So we've got 1, 2, 3 to the 4, Snoop Doggy Dogg and Warren G at your dope. We've got 6 equal lows, right? And we don't have any current valid equal highs. So I'm going to remove these equal highs because price has surpassed all of these areas, so they're all irrelevant, right? Price has come all the way up here. Now, it's not a surprise, guys, that we can now see price coming down lower, and it's targeting these exact same areas, these equal low areas. We have the equal low area here, equal low area here, this one here, this one here, this one down here, and we even get this equal low down here taken out. Now, this is a game of equal lows versus equal highs. That is all you need to think about. When we're trying to understand liquidity, we need to understand that the equal low is just as important as the equal high, but whichever one has more than the other is going to give us the direction of the market. Now, above an equal high or beneath an equal low is liquidity. We always have to remember that liquidity is what drives the market, and the market cannot move without grabbing liquidity, and it cannot move without creating liquidity. What do I mean by that? Well, if the market wants to come down, first it will push up. If the market wants to fly up, first it will come down. Okay, we will always get these reactions happening in the market without fail. The market is not going to just fly upwards first without coming down to grab the liquidity. An example is here, right? Price pushed up, then it came down. It didn't just come down and come down and come down and come down. No, price went up first, then it came down, right? So we can see the equal lows now being taken out as price is coming down lower, which means all of the liquidity below these areas, they're now being taken, right? All the money beneath these areas have been taken, and in the process, what are we now seeing? We're seeing these equal highs now. We've got equal lows inside of here, but guess what's happening with the equal lows? With this equal low here, this equal low here, this equal low here, equal low here, equal low here, all of these lows are irrelevant. Why are they irrelevant? Pause the video quickly and answer. Why are these equal lows now irrelevant? Looking at this picture, why are these equal lows irrelevant? They're irrelevant because price has ended up down here. So the only equal low that is relevant is the one that I've just marked out, because the rest of them, price has surpassed them, right? Price has ended up coming all the way to the bottom. Let's have a look here. Price has come all the way down here. Okay? Now, when we're looking at the charts here, what we want to understand when we think about liquidity is how long the market is prepared to leave money on the table. And in this instance, money can be left for a considerable amount of time, guys, okay? These banks, these institutions, they're trading with trillions, okay? They're trading with triple-digit billions as well as trillions. So they can afford to leave money on the table. So when we're looking at the equal low factor and versus the equal high, now what we're seeing is that we've got a few inconsistencies here, and I want you guys to try and figure out what. Now, I've got some on my chart right now. I've got some equal lows, I've got equal highs on my chart right now, but some of them aren't valid, some of them are. So again, pause the video, take a screenshot, and just try to figure out which ones aren't valid before I show you guys, okay? So to show you guys which ones are no longer valid, we're going to start from the top, working our way down. These equal highs are fine. This equal high is not fine. This one is not fine. This one is invalid. This one is invalid. This one's invalid. This one here is invalid. This one's invalid. And this one's invalid. So what we found is the majority of these equal highs, they've all been invalid. Okay? And essentially price starts going back up. Now, again, okay, even though the equal lows, a lot of them was invalid, right? All of the equal highs, even though all of the equal highs, a lot of them was invalid, okay? there are still more equal highs than equal lows. There's only one equal low, which is the one down here at the bottom. So now if we count up the equal highs, 1, 2, 3 to the 4, Snoop Doggy Dogg and Warren G at your door. We've got 5 equal highs, yeah? 5 equal highs versus 1 equal low. Now, if we go back to our message here, if there is more equal highs than equal lows, price will most likely go up. So again, we don't have a time period as to when it's going to go up, but we start to see now, we start to form a bias in understanding why price is going to go up, because there's more money above. And wherever the money is, price is going to go. So now what we start to see happening is price pushing all the way up. And it's not a surprise that price comes up, takes out all of the liquidity that was on the table. And then they start to create the same picture now by doing the same cycle over and over and over again. And that cycle, guys, is creating equal highs, creating equal lows, creating equal highs, creating equal lows. We see it happening, and this is why the charts are always ranging. This is why the charts are always moving from left to right, right to left. Now, an example I want to show you guys is what it looks like when price is actually performing a liquidity grab. Now, we had a high inside of this area here, but this wick, okay, if you were selling and you had your stop loss above this area, okay, above the previous high, which most retail traders do, when we see wicks such as this is an indication that price's sole objective is just to grab the money that was left in this area. So if you remember back in the beginning of this video when I said to you guys, hey, there's money that's left on the charts, and we can see the money that's left on the charts in terms of areas like here, 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 and here, right? You guys should remember this. Well, this is the classic example of money being left in a specific area, which is the reason why price came there. Now, I can guarantee you guys, and I'm telling you this so that you guys know for future references, price will always go where it's been before. And if it's made an all-time high or an all-time low, price will then start to create an equal low or an equal high, because that's in the process and the foundation of the market making structure, right? The market needs to make structure. It can only do that by making equal highs and equal lows, higher lows, lower highs, right? But when we start to see these huge wicks, these wicks are saying to us that there was enough money inside of this area. So what I wanted to do was I wanted to create as much as safety as possible. I wanted people to feel like this area was impenetrable. This area was not going to be touched. So to do that, from a market maker's perspective, I'm going to push away from this area. I'm going to keep pushing away from this area so that people, when they're down here thinking about selling, they're thinking, yeah, okay, maybe here's too close, maybe here's too close, but here's going to be fine. And don't get me wrong, guys, if you're selling here, some people place their stop losses here, they placed it here as well as here. But what's happened in one candle, this one candle that's pushed up, that was the candle that was the bogeyman. This candle was the bogeyman. It came to take your money, it came to grab the liquidity. This massive candle, and then price comes back down, shows you that actually this candle's true intention was to grab the liquidity. And you'll see this happening over and over and over again. I can at randomly keep scrolling and show you another candle. We find this candle here. This time this candle's performing the same action. The wick takes out the high. Notice the candle doesn't close above the high, okay? Or if it does, it barely does. It kind of makes equal high, but we see the wick closes above. The wick, sorry, doesn't close above, but the wick does go above and it takes the liquidity. Okay, we can see it happening on the downside as well as the upside. Over here, we've got an equal low, price comes down with the wick. Whenever we see these wicks, okay guys, you have to understand these wicks are simply grabbing liquidity. They're simply saying, hey guys, leave your money inside of this area. And once there's enough money compounded inside of that area, the wick will come and say, thank you, come again. So this is something that we can see happening over and over and over again. Of course, this is GBP AUD, so naturally GBP AUD is a bit wicky, but nonetheless, this practice, this theory, this method, the strategy of what I've just taught you guys, it can be used on any and every single asset class. It can be used on commodities, it could be used on Forex, it could be used on indices. It's important to understand liquidity. If you can understand where the money is, then you can always understand and have a sensible bias. You can form a bias on the direction of the market because you're basing it off of logic, not sentiment, not because your heart's telling you this or because you think it's this. No, you're clearly seeing, bright as day, there's more money above than there is below. If there's more money below than above, price will come down, vice versa. So look guys, if you've enjoyed this video, if it's made sense for you, comment in the section below. Let me know how valuable you found this video. If this video, of course, if you'd like for me to maybe give you another explanation, maybe you guys have other videos that you want me to further break down for you. Whatever it is, just be sure to leave a comment in the section below and I'll try to help the best I can. And of course, if you found this video valuable, make sure you like, subscribe. You know the vibes, it's lit side. Thank you guys for watching. I'll see you guys next time.